Welcome back to the Deep Dive. We are jumping into a topic that, well, it impacts every single one of you, and the clock is seriously ticking. We're talking about year-end tax planning.
And this is not just your normal end-of-year sprint.
No, not at all. 2025 brought, the most significant changes to the tax code we've seen in more than a decade, all thanks to that massive new legislation signed back on July 4th.
It completely reshaped the landscape. And what's really important for you to understand is that these changes, well, they were designed to provide relief, but they've actually introduced a ton of new complexity.
So people are making mistakes.
Huge mistakes. We're seeing countless taxpayers making these critical errors, either by, relying on old strategies that just don't apply anymore, or by simply missing brand new opportunities. And these mistakes are costing them thousands.
And the window to actually do something about your 2025 taxes, to influence the outcome, it closes for good on December 31st. Once that calendar flips, that's it.
You're just reporting history at that point.
Exactly. So our mission today is very straightforward. We've gone through the source material and we have pulled out these 7 most costly mistakes people are making right now. And more importantly, we're giving you the specific, actionable fixes you can use immediately.
Right now, before that deadline. So let's get straight into it. Let's start with the big dollar amounts, the credits and deductions that have just fundamentally changed this year.
Okay, let's unpack that with mistake number 1. Ignoring the massive expansion of the child tax credit.
This is a huge one for families. If you're calculating anything based on old tax forms, you are already behind. The source material confirms it. The credit is permanently increased to $2,200 per qualifying child.
$2,200.
Per child under 17. And crucially, it now has built-in inflation adjustments. So this wasn't some temporary stimulus thing. This is a permanent structural change.
So for a family, this is a huge potential dollar jump. What is the immediate fix? What do they need to do before the year's over?
The fix is calculation and then adjustment. It's immediate. So let's say you have 3 kids. That's a potential $6,600 reduction in what you owe.
Wow.
So you need to review your situation and then proactively adjust your W-4 withholdings with your employer. Or, if you're self-employed, your 4th quarter estimated tax payments.
So you get that money now instead of giving the IRS a loan.
Exactly. The whole point is to account for this bigger credit now. You don't want to overpay all year just to get a bigger refund in April. You want that money in your pocket today.
That's great cash flow advice. Okay, so that's the child tax credit. Now let's talk about a mistake that really changes the math for everyone. Mistake number 5. Misunderstanding the higher standard deductions.
This is the foundation. It's the foundation for every tax decision you make, and the entire foundation just moved.
It's a whole new ballgame.
It is. The standard deductions have permanently increased to levels that just completely alter that old itemized versus standard calculation. We're talking $31,500 for married filing jointly.
31,500.
$15,750 for single filers, and $23,625 for head of household.
Those numbers they're just massive jumps. So if my personal situation hasn't changed, but the code has, what's my action item?
The fix is simple. You cannot rely on last year's approach. You just can't. You have to recalculate your strategy from scratch.
Okay.
A lot of people who maybe had some mortgage interest, some state taxes, they used to just barely clear the threshold to itemize. Now, with these higher limits, many of them should go back to the standard deduction, but we have to immediately talk about mistake number 2.
Ah, yes. You can't talk about the standard deduction without bringing up the massive shift in the SALT deduction, the estate and local tax deduction.
Exactly. This is where that itemization math gets really interesting. Historically, the SALT deduction was capped at $10,000.
Which made it almost irrelevant for a lot of people in, high-cost states.
It did, but the new law changed that dramatically.
So what's the new number?
For taxpayers earning up to $500,000, that limit jumped from $10,000 to an astonishing $40,000.
$40,000?
$40,000. This is the single biggest policy shift for anyone living in a high-tax state. New York, California, New Jersey. They're specifically cited in the source material.
But there's a catch.
There is. This is a crucial detail. This enhanced $40,000 limit is temporary. It's set to expire after 2029.
So if we connect all these dots, the higher standard deduction, this new SALT cap, how does somebody translate this into an actual decision before December 31st?
Okay, so it requires running a specific scenario. Let's take a married couple in, say, California. Last year, their standard deduction was around $29,000. Let's say they paid $18,000 in state taxes and $10,000 in mortgage interest.
Okay.
With the old $10,000 SALT cap, their total itemized deductions were just $20,000. So they wisely took the standard deduction.
Right. Itemizing was a total loser for them.
But now, with the new standard deduction at $31,500 and the new SALT cap at $40,000, their itemized deductions suddenly become, well, wait, let's do the math. $18,000 in state taxes plus $10,000 in mortgage interest. That's $28,000.
Ah, so it's still below the new 31.5 standard deduction. That's the trick.
Precisely. You still need more deductions to get across that new higher finish line. You'd need another, what, $3,501 in deductions, maybe from charity or medical expenses?
Thus, the fix is twofold.
Exactly. First, if you're in a high-tax state, you have to gather all the documents for your 2025 state income and property taxes paid, like now. Second, you have to figure out if you can find enough other itemized deductions to beat that 31.5 threshold. If you can, itemizing suddenly becomes a huge win.
That perfectly shows the complexity. It's not just about one big number changing. It's about how all the numbers interact.
Right. And we've just covered the shifts in existing stuff, but what's really fascinating is that the new law created brand new deduction categories. This is easy money left on the table because it just didn't exist last year.
Which brings us right to mistake number 3.
Yeah.
Overlooking these brand new deductions for things like tips, overtime, and auto loans.
Right.
These aren't just little tweaks.
No, these are brand new lines on the tax form. And, the devil is in the details, or in this case, the documentation. First, let's talk about the qualified tip income deduction.
Okay.
This was put in as targeted relief to help with inflation for low and middle income service workers.
So who qualifies for that?
Service industry employees, we're talking. Restaurant staff, delivery drivers, anyone who gets a lot of tips. The deduction itself is tied to your total qualified tip income for the year.
So the fix is all about record keeping.
It's urgent. If you're in the service industry, you have to make sure you have meticulously recorded all of your tip, income, digital, cash, everything, and that your employer is reporting it correctly. This is a brand new deduction, which means the IRS is going to be scrutinizing these claims very closely.
Yeah, that makes sense. They don't have a history for this data, so they'll be looking hard. What about the second one, the qualified overtime pay deduction?
This one's much more narrow. It doesn't apply to just any salaried overtime. The source material points to very specific worker classifications. Think essential service workers, healthcare providers, maybe first responders who had mandated overtime this year because of labor shortages.
So you have to check if you're on the list.
You have to check the specific statutory definition. The fix is to gather every single pay stub that shows those qualified overtime hours and the wages you were paid for them this year.
And finally, the auto loan interest deduction. This one sounds a bit like mortgage interest, but for a car.
That's a great way to think about it. It covers interest you paid on certain vehicle purchases made in 2025. It's not for every car, though. There are limits on the vehicle type, the price, that kind of thing.
And the action item.
The action right now is to locate all of your 2025 auto loan statements. Your year-end statement will tell you exactly how much interest you paid. If you refinanced or paid off a loan this year, make sure you have that final paperwork too.
So if you served tables, worked mandatory extra shifts, or bought a car this year, you need to be checking these boxes for mistake number 3 right now before those documents get lost.
That's nice.
Okay, let's transition. These last 3 mistakes they're less about the tax code itself and more about crucial procedural and timing errors. And these kinds of mistakes become so much more costly when you have massive new laws in place.
Yeah, they become magnets for IRS attention. Mistake number 4 is a classic trap, but it is so much bigger this year, filing before you have all your necessary documents.
We all feel that pressure, right? To file early, especially if you think you're getting a refund. But with these brand new provisions, like the tip income deduction, that means new forms, new reporting.
And if you file too early, you risk missing the paperwork for one of those new credits. Then you're forced to file an amended return, a Form 1040X, and trust me, the pain of filing an amendment is immense. And it often flags your return for a manual review.
Which nobody wants.
Nobody. The fix is to create a checklist of all the documents you expect to get. Pay special attention to things like Forms 1099B for investments and 5498 for retirement contributions. But the real risk this year is specifically those new documents.
Right. An employer might be late issuing a new form for the overtime deduction just because they're still figuring out their systems.
That's the core insight. Our advice is just to wait. Wait until at least mid-February. Give everyone time to send out all the new, maybe unfamiliar forms. A little bit of patience now prevents a massive headache later.
Okay, good advice. Let's move to mistake number 6. Poor year-end tax planning and just procrastination.
This is probably the biggest procedural mistake because it means you miss the chance to actually create your best possible tax outcome for 2025.
You're right. Most people wait until March or April, but if you want to influence your 2025 taxes, you have to make certain moves before December 31st. So what's on that urgent, actionable list?
The list is long, but strategically, you have to decide if you should accelerate or defer income. For instance, if you think you'll be in a higher tax bracket next year, you might want to pull some income into 2025.
What else?
Bunching charitable contributions is a big one. If you can suddenly itemize this year because of that $40,000 SALT cap, you might make 2 years' worth of donations now to maximize that deduction and then just take the standard deduction next year.
And of course, maxing out retirement contributions. That's a huge one every single year.
Absolutely. And harvesting investment losses to offset gains. But let's go back to that expanded SALT deduction for a second, because there is a very specific strategic move you can make here with estimated payments.
Okay, tell us about that timing trick.
So this is pretty high-level optimization. If you live in a high-tax state and you're certain you'll be itemizing, you might strategically pay your first 2026 state estimated tax payment before December 31st, 2025.
To pull that deduction into this year.
Exactly. It lets you use more of that temporary $40,000 SALT deduction limit while it's available.
But wait, paying 2026 taxes now? That's a big cash flow hit. How do you know if it's worth it? Is this only for certain people?
That's the critical question. This move is only advisable if you are absolutely sure you'll itemize and that your total itemized deductions, including this extra payment, will be substantially higher than the standard deduction. It's really for high-level optimizers who have the liquidity to do it.
So if you're close to the line, probably not worth it.
Probably not worth the cash flow hit. But for high-income earners trying to maximize that temporary cap, timing that payment before December 31st is everything.
Timing is key.
Okay.
Last one. Mistake number 7. Making just careless errors that trigger IRS scrutiny.
Yeah, the basic stuff. A wrong Social Security number, math errors, wrong filing status. These things have always been a problem, but they're especially risky this year.
Why this year specifically?
Because you are likely claiming new untested deductions, like that tip income deduction or the auto loan deduction. The new claims already draw scrutiny. A simple typo just magnifies it.
So a basic error becomes a magnet for unwanted attention.
Exactly. The IRS system will likely flag returns claiming these new deductions anyway, so any other careless error on top of that just screams, "Look at me." You need a clean return to sail through.
The fix here seems to be just extreme vigilance.
It is. And using modern tools. Triple check all your personal information, use tax software, it catches the basic math errors automatically, and create a meticulous pre-filing checklist. Verify names match Social Security records, confirm bank account numbers, and critically make sure you have the correct documents for every single new deduction you're claiming.
This has been incredibly helpful. So let's recap those big opportunities. We have the enhanced child tax credit, $2,200 a kid, which means you need to adjust your W-4 now.
The temporarily expanded SALT deduction, up to $40,000, which completely changes your itemizing strategy.
And those entirely new deductions for tips, overtime, and auto loans, which all require you to gather your documents immediately.
And the key takeaway through all of this is that these benefits only help you if you actually claim them correctly. The 2025 tax year is, without a doubt, more complex than previous years. We've seen these major shifts that break all the old habits.
So if your situation has changed, if you're suddenly looking at itemizing again because of that SALT limit, or if you're trying to navigate those 3 brand new deductions, it sounds like trying to do it all yourself could actually be mistake number 8.
It absolutely could be. Honestly, the cost of working with a qualified tax professional who really knows these new provisions, it often pays for itself many times over through optimization, avoiding those procedural traps, and just ensuring you don't leave money on the table.
The next few weeks are going to determine whether you optimize every single advantage you have or if you leave potentially thousands of dollars behind. The time to gather that documentation, to run those calculations, and to make those strategic moves is right now. December 31st closes the window on your 2025 tax year forever. Don't let this opportunity slip away.